Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. And I know you're going to enjoy today's guest. He's a friend of mine. We're actually on a high-dollar, high-end digital marketing mastermind together, and that's how we met. And his name is Sal Buscemi, and he's a managing director of Dandrew Partners. Now, Sal knows how to find money, and basically, he knows how to raise capital on demand, even in a tough market. So we're going to dig into that. And, as you guys know, we're headed into a contraction, and it's going to be a tough market here before too long. Tough to get financing. And so we're going to tap into Sal to tell us how to find that money when that happens. Sal, thanks for being on the show, buddy.
Rod, it's a pleasure and a privilege. Thank you so much for having me on.
Absolutely. So maybe you could take a minute and just tell us a little bit, fill in the blanks on your intro, how you got started in this business, where you came from,
Sure.
and who you are.
Yeah, I started out in this business early on after college. I got a job working at an investment bank on Wall Street. I started out working at Goldman Sachs, and I started out in the late 90s. I was actually working on investment banking side, doing several other things. I just had mouth surgery, Rod, so I apologize for this. But the key takeaway was that I learned from the best and brightest bankers at Goldman Sachs how to be able to raise money and place it into assets. I learned long ago when you work at an investment bank, you learn that the biggest names on all the biggest buildings around the world, and I've been to small cities to large cities, they all have the name of banks on them, not landlords, not even Trump Tower, for example. So we made the cognitive decision to, at a very young age, to be able to transition. I was working with some very sophisticated family offices, wealthy family offices, $200 million or more in net worth. And then after that, I saw in 2007, 6, that trees were actually not growing to the sky anymore. And I used my, what I call intellectual capital or experience and my network to be able to raise $30 million from another hedge fund. And we started a defaulted residential non-performing loan pool. But we were principal bid, and we did pretty well with that. We became basically the kitchen sink for Bear Stearns. We would buy all their rough subprime loans, non-performing. I'm sure you're familiar with what I'm talking about.
Sure. Back in the day, in fact, some of mine may have even got dumped in there when I imploded in 2008. You probably ended up with some of my houses, you rascal.
Probably.
By the way, for my listeners, family office is when you have a very wealthy individual, they'll typically set up an office to handle their affairs, everything from their finances to their taxes to their security on down the line. And so they can be a fantastic source of capital for your deals. In fact, I remember going to a family office conference in Miami a while back, but they're very high net worth, anywhere from a few million to billions. So anyway.
Well, real ones, the ones that I go to, start out at $100 million because it costs about $1 million a year to operate it. Think about Paris Hilton, right? She has a private jet, her own lawyer, when she gets into trouble, all that kind of stuff. But that's really, we've tapped into a lot of institutional capital. In 2010, we saw something happening with commercials. So we bought a servicing company and raised $15 million around it. And that got me to Las Vegas. We were buying a lot of hard money funds that were in receivership and bankruptcy. A lot of these private lenders were blowing up because subprime wasn't there anymore and commercial loans weren't being made. And then fast forward to that, we saw an opportunity, and we decided that we were going to raise $55 million for a fund which would buy grocery-anchored triple net lease retail stores. And we raised $19 million before we all gave it back because we weren't comfortable with the prices at that point. So,
and when was this? What year was this?
This was 2015. We gave the money back.
Okay.
Yeah,
So you tried to do a raise. It didn't come together. You weren't happy with what you saw, and you gave the money back and moved on. That's not a happy day.
No, it's not. But I'll tell you, it does wonders for your reputation, right? Because this is our first mom and pop raise, non-institutional. So there are a lot of people out there who are trusting us with their life savings, right? And what is life savings? It's savings after taxes. It's like all the years you worked after taxes. This is what you're left with. And we learned a lot with that because a lot of people are sophisticated. They're like, you know what you're doing, you mature. If whenever you want the money back, just give us a call. That's maturity. A lot of hedge fund managers do that. That's professional maturity. And then you have the other people who are like, well, I thought you were going to use it. I thought this was Shark Tank money. And they were a little upset and annoyed, but I also know I'm never going to call them back again because they're not sophisticated. And that wasn't really their money to begin with. They'd probably refinance their home or something like that. So
right. Right.
I get really, really passionate about that, making sure that when you're managing other people's money, you're managing their life savings. And, I went through my bio pretty quickly, but the point of the matter is that those are the things that I've learned on Wall Street, that those are core principles to me that I would never violate.
Okay. So to recap those core principles, could you do that?
Yeah. Treat your investors' money like it's your own, or it's like
Okay.
your mother-in-law's. You don't want to lose your mother-in-law's money. Right?
Right.
And always be prepared to ask the hard questions, right? Where's this money coming from? Can you afford to lose it? Because there's no such thing as risk-free investments. You can lose money just buying treasuries if the prices change. But the point is you want to make sure that you're aligned. And you always want to do the right thing. If you can't find a good opportunity, don't just invest in something and overpay for it just because you have the money available to you and it's not yours. You always want to make
guys, those of you listening right now, with the market as hot as it is and it's frothing, that's the one that you want to be most careful with, because just because you have people ready to give you money, you don't take down a deal for that reason. It's got to be a value add deal. You've got to see opportunity. You've got to make sure your investors are protected. And right now we're going into a phase where that is probably one of the most important parameters, is to make sure it's actually a deal. Yeah. And that it can sustain a downturn, that the cash flow numbers are there, the debt service coverage ratio is safe enough if you're bringing on debt. So let's talk about the topic, how to raise capital. I just interviewed somebody earlier today that was talking about how he couldn't refinance his properties in 08 and 09 because, of course, the banks had locked up and he had these great cash flowing properties. He couldn't pull his money out because, banks are funny. When the market contracts, it's like they all go hide they're like ostriches with their head in the ground. And it really causes more damage than not just typically to them, but to the economy as a whole. So how do you raise capital when that happens? Because it's going to happen soon.
It is. And what you have to do is you have to lean more towards the private investors. You see, I come from a school, but, I don't follow sports. I follow the markets. These are my passion. I mean, obviously, this is what I do. And you and I talk about this all the time. And AJ was a poster child for this. So when you're looking at properties, I assume you're talking about multifamily. What happened is that when you get a multifamily loan from anyone, you have to deal with loan covenants. This isn't getting like a residential loan or anything else. There's covenants there. There's got to be a good DSCR, debt service coverage ratio. There's got to be some things that you need to apply. And if those aren't being held, then the bank can call the loan due. Right now, what you're going to see, and I'm going to get to answer your question, is that there was a lot of loans that were underwritten off of the pro forma, which is basically a lie, right? I mean, they were underwritten off the pro forma, and this was back in 2006, 7, and 8 that are coming due now. And that's what we call a technical default. So there's going to be a tremendous amount of opportunities for people to get these properties at discounted or low basis due to the fact that these people can't get out. So where's the money? That's the opportunity. So that's your edge. That's how you're sourcing these deals.
Can I stop you 1 second? I don't want to interrupt your train of thought, but
that's okay.
But guys, if you're buying property, you never, ever, ever, ever buy based on the pro forma. You buy on actual numbers. They're brokers, particularly larger brokers, they all send out a pro forma, and it is a wish. It is a guess. It is at best a guess. And so you never buy based on pro forma. You always look at actual.
Absolutely. And I wrote a whole blog post on that too. But the point is that the brokers are trying to always make someone stupid overpay for a property due to the fact that it's over leveraged.
Right.
Okay.
Right.
That's the way it is. So if you look at we have the 5 data points. If we're looking at something, there's the current NOI, the pro forma NOI, the current debt that's on it, the debt structure, the sources and uses, and the exit strategy. And I can tell you the most important driver for value in any multifamily is the current NOI.
Current NOI, yep.
And that's found on page 80 of the broker,
Right.
Current NOI,
right.
And
underneath, where's the beef? It's underneath. It's underneath the pickle.
Exactly,
right?
Exactly. But on the pro forma is on page 1, and it's beautiful. And there's a lot of like trickery and tomfoolery, legerdemain, whatever it is, where you look at these and you actually peel back the layer of the onion. Like, this guy's offering a multifamily at a 3 cap. And this doesn't make sense to me. But that's what happens. And that's financial Darwinism. And that's how a lot of doctors, dentists, chiropractors get fleeced. And and this is just, again, this is how the industry works.
Nothing against doctors, dentists, or chiropractors, but they have money and they love to invest, but they don't, very regularly don't do their homework or don't align themselves with somebody who knows what they're doing.
What they don't do, they don't look at the numbers dispassionately.
Right.
They get, everybody gets in with the emotion. They're like, this is great. I can't wait to get in. But you have to look at the numbers dispassionately. And we use very rigorous models to do that. They're not that complicated, but they're very, very strong models that I used on Wall Street. So when you're talking to these guys, I'm going to go out there and I'm going to say something that's probably going to be controversial, and you're probably going to spank me for it. But you're a young guy, right? I'm around, not close to your age, but I'm a little younger. I'm 42. I don't see any catalyst for rates to increase meaningfully in our lifetime. And if you look at the horrific events of 2001, when 9/11, Alan Greenspan brought rates down to just about zero at that point, there's just no inflection point or reason where we can afford to have rates increase anymore. We can't hike up our own interest rate on our own over-leveraged credit card bill. It's not going to happen. So you're going to have a lot of opportunity where people are going to be chasing you with money to put into these deals, and you need to know how to structure that. But the most important thing you need to do is you need to be able to talk to the investors as if they're grown-ups. And I can't tell you, we had our associate Riley at the ISS conference over here for self-storage, and the paperwork, I mean, it's embarrassing. It looked like the back of like a Starbucks napkin that they were communicating
What
the
paperwork,
deals.
Sal?
Their pitch book, how they were pitching the deal. Like they didn't know what they were doing. And you're talking about going up to these sophisticated family offices. They have a lot of money, but they're also very smart. And they have a CIO that looks like Rod, he's established, mature, that's the word I'm looking for. But like he's going to go through this and say, whether this is crap or not. And you have to be very careful about how you communicate the deal. That's the most important part. If you can communicate the deal correctly, you are almost guaranteed limitless amount of capital.
So describe a pitch book, Sal.
A pitch book talks about the deal. It's different from an investment memorandum. Remember, there's a lot of these investment memorandums, but they're written from the sales side. They're meant to sort of, I'm trying to use a word that doesn't say lie, but it's meant to sort of pull the veneer over the building. And it's a way for them to distract you into what's important.
So you're talking about the offering memorandum from a broker.
Correct.
Right.
Yes.
Okay. So that's step one, the offering memorandum. So
we don't look at that.
Right. Describe the pitch book. What are the components of the pitch book? By the way, guys, there will be a link to get Sal's free done-for-you pitch book in the show notes, and I highly recommend you get that because it's a great example. But I want to go. Let's talk about the components of that pitch book.
Sure. Number one, the first part is deal sourcing. How are you sourcing these deals? Okay, that's important. I have a theory that the wider an opportunity is marketed and made available, the less worthwhile it is. So maybe you have you have a brother-in-law that works at a bank. Maybe he's a bankruptcy attorney. Title companies, you have relationships. You have certain relationships where you're able to source the deal flow.
Let me pause you. I'm going to pause you a couple times here so I can fully explain.
This is important.
So deal source obviously is where you find the deals, and that's why we do everything off market. It's very difficult to find a deal on LoopNet or some of these other MLS sites. I'm not going to say they're never there because sometimes deals are there that people don't fully analyze, but they're much more difficult. So have a mailing campaign, have the relationships with the brokers for off-market deals, have the relationships with the bank like Sal just described. So you're actually going to put your deal sourcing in the pitch book.
Yeah. You're going to be, this is you totally exposed. Here's where I found the deal. It's off-market. I had a reputation. I have a relationship with a bank, and the guy's giving me first look, and it's the opportunity. And I'm just going to go through this, and then you can interrupt it again. But this is what you want to remember. And I hope this is being transcribed because I'm just flying this off the top of my head. Number one, you want to say that this is an opportunity because the prior owner-operator defaulted on his loan. So now you're able to buy this at a discount from the bank. They're looking to sell off the note, or they're looking to sell off the property itself. That's number one. Number two is what you want to talk about is where the area is, a little bit of demographic information and why it's strong. Number three, comparables. If these things are all trading, say, like an 8 cap in Tampa, Florida, okay, you want to show that you're buying it for higher than an 8 cap at Florida, and you want to show some comparables of recently traded product that's the same. So now you're establishing the value equation. Now you're saying there's real value here. I've been able to show value. I'm doing it through comps. By the way, I might have an Excel spreadsheet I'll show you later, but you're saying, hey, I'm actually buying this at a discount, and here's how you can tell. Number four, and this is something that's so important, and people screw this up. If I give you $1 today, where does it go and how does it come back? I like doing this as like sort of like a transactional life cycle where you can actually see the dollar comes here, it's in an LLC, a holding company, other capital comes in here. This is where your money is. This is how secure you are. And this is all in that tool that I'm giving you. But the point is you want to tell your investors where the money's going. How are they secured? Are they debt? Are they equity? Are they preferred equity? If you don't know what that means, don't worry about it. But the point is that where are they in the capital structure and how are they secured and how are they remedied? Meaning, if you default, are they going to take the loan back or do they step into your shoes? There's all sorts of things that you can do, but you want to be able to detail that. And that's very important there. And that's for the 4 components, I think, to a great pitch book. And 5th one is, how are you getting out? How are you going to get out?
An exit strategy.
Yeah,
Okay.
what's the exit strategy?
And of course, I assume that you'll have bios of all the principals on the team.
Absolutely. Yes.
You'll speak to their experience and their credentials and all that business, pictures, all of that. Because basically, a pitch book is just that. It's you pitching yourself to a source of money. And you would use this for a regular lender as well, not just private lenders. You'd use this for a banking institution, financial institution, but definitely. If you're going to family offices, if you're going to hard money, of course they want to know everything about the deal, but they also want to know about you. So let's dig deeper. As things slow down, financially, as it becomes harder and harder to find money, for my listeners, let's say you've got a listener that doesn't have great credit. Maybe they don't have significant income. They want to get into this business. They want to find the money to do deals. That maybe they found a deal or they know how to find deals or they're willing to do whatever it takes to find deals. What would you tell them about how to source the money?
I would say, number one, today with the internet, it's easier than ever before to be able to source the money. I told you earlier on, we raised $19 million for a fund that we were putting together. Now, I have a pedigree, right? I have a certain background that a lot of people don't have, but I'm assuming everybody here does not have that. Right. What you need to do is you need to go out there and you need to do the quiet pitch. You need to go out there and say, look, I'm seeing a lot of opportunities happen right now. Rod, I think that banks are going to come into trouble. There's a new Treasury Secretary. He's a deal guy. Nobody's going to mince any words, and he's probably going to make the banks flush out. There's going to be a lot of opportunity there. But that's like the conversation you have during the holiday weekends, the barbecues, things like that. And that's how you start to build notoriety for yourself. And then at that point, then you start saying, well, here's, it was great talking to you, Rod, at this barbecue. Here's a pitch book of a similar deal that we've done before, and it could be a fake deal. That's fine. You're not misleading anyone, but you're just preparing them. These are the type of assets we like, multifamily, less than 200 units, whatever it is. And then you say, when something else comes up, would you be interested in looking at this opportunity and investing as a private lender pooled with other private lenders into this deal? And the answer is going to be yes, because they like you, because they trust you, and you're not running around like a chicken with his head cut off. A lot of times people run around, they'll find the deal, and then scramble to find the investors, and then they spook the investors because they're desperate, they don't know what they're doing, and there's a lot of pressure for them to close on time. Here, what you're doing is that you're actually finding the date to the prom first, before you pick the wedding, the prom dress. And that's really the most important part to do there.
No question. And guys, make sure that you develop an elevator pitch. Basically, it's something you can say in 2 minutes about, hey, I'm finding these great deals. I'm always looking for partners or investors or lenders. And you used a lender example. You could also just say, I'm looking for an investor or partner that, wants some equity in a deal, and start those relationships, because that's really what it is, relationships.
It's all relationships.
And then once you have a deal or an example of a deal, you show them that. And, it's going to take developing that relationship before they're going to trust you enough to give you money. But you start those conversations, like you said, over a barbecue, at a local meetup group, at a friends of friends, and you get the greed glands going. I'm getting these great returns on these deals, and I'm always looking for partners. So if you ever know anybody that's interested in getting involved, let me know. I might be. Okay, well, super. Yeah. I'll let you know when I find something, or I'll show you an example of when I did.
Yeah.
Right?
Yeah, it's the example. That's what it is. It's like, these are the type of things that we're looking at. This one, we closed, or it's gone on, or something like that. Right. But this is the type of things. Here's what's going to happen next. I'm going to follow up with you. I'm going to send you an email. It's going to be a PDF of the pitch book, and you're going to use that to communicate to them the deal that you have. And the best part is that you have professionals all over. There's a lot of problems where I think people get really worried. The last thing, and I would tell you this specifically, and I know you and I have talked about this, Rod, a couple times, is make sure you tell them that there's professionals involved, okay? Don't take their money and put it into your hip pocket. Make sure that you're opening escrow with the title company if something comes to that point. Make sure you're using a property management company that's collecting rents, and it's not you doing it, right? Because you're not saving your investors any money. I mean, it's not. I mean, I told AJ one time, he used to manage his stuff at one point. He has a substantial portfolio in Iowa, where he's from. And he said he finally.
By the way, guys, AJ is Sal's right hand man. He's a great guy that I happen to know as well. So so people know who AJ is. Okay.
So but it's funny, I was telling one guy, he's like, "Oh, I managed it all myself." I'm like, "You must really hate your spouse and children." and he's like, "No, what are you talking about?"
All right. This is somewhere. By the way, this is a topic where Sal and I kind of disagree. I'm not sure if we're actually on the same page with our definition of self-management. Sal believes in outsourcing all management. My definition of self-management, Sal, for your purposes, is hire a property manager. If you have enough infrastructure, do it yourself until you can hire somebody to do it for you, but have them on your payroll, not hire an outside management company. That's my definition. And and I've interviewed on my show people that have had a few hundred units to tens of thousands, and all the big hitters seem to manage their own. Now, I will tell you, though, with one caveat where I do agree with you, and that is when you are in acquisition mode and you don't have the bandwidth to screw with it, then I would definitely hire outside management while you're acquiring. But once you settle in, I'm a big proponent for self-management. And again, my definition is have a team, your own team, which is what I want to talk to you about next. But as it relates to buying, but as it relates to managing, I've got a full-time property manager across the office here from me right now. But anyway, back to team. Let's talk about team.
Sure, of course.
So you said have professionals with you. What does that mean to you?
To me, that means having a real estate attorney, not your brother-in-law who's a divorce attorney or an ambulance chaser, personal injury. Okay, these guys, they're not that expensive, but depending on the deal, they should have experience, good transactional experience, where they can actually put the deal, paper the deal together, an operating agreement or whatever, you can define what that is, Rod, later. But the point is making sure that everybody trusts a lawyer at some point. When you say you're getting a lawyer involved, it means something's going serious, right? Whether you're on United Airlines or whether you're raising money, that usually has some sort of notoriety. Number two is, I like to, again, a property manager. If you're just starting out and you're in acquisition mode, you're not going to have the luxury of what you have, Rod, of getting a property, hiring someone.
Agreed. And the second reason in acquisition, by the way, and sorry to interrupt, but
that's fine.
Unfortunately, I'm real good at that. But the second reason is if you don't have the skill set or the experience in the size property that you're taking down, the bank's going to require you to hire one anyway.
That's exactly right.
And that's the best way to learn is through an expert property management company.
Correct.
And so we're in agreement. So, attorney, definitely transactional attorney, definitely syndication attorney if you're syndicating for sure. And they may not be the same person. And then property management. Okay, what else?
Yeah. And then what I like to do is I like to, it's usually me because it's me, I'm sort of the name of this, but we've moved on to people internally who do all the paperwork and the post-closing stuff. That means it's like after you close, okay, the money goes where and how does that get distributed? For example, we did an offering not too long ago where we'd be raising what we call private lender money, but we call it, Wall Street private credit. And so everybody would, we levered it 100% LTC, and we did this for somebody else's deal. And what we did was we are partners in that deal. We have the equity, but we were able to get in at a good discount. Now, it's one thing to buy something, but what happens afterwards? So you have to communicate with the investors.
Let me stop you. Let me stop you for 1 second because you said a lot, and I want to catch up. So LTC, obviously, guys, is loan to cost. So basically, he got it at 100% loan to cost, which it doesn't get any better than that unless you're over leveraged. So that's another conversation.
I can assure you, we're not right.
All right, so if you're buying really well, then you can finance 100% of it. All right, so continue. So you're talking about investor relations, right?
Yeah, talking about investor relations. So, okay, so now we're married. Now we're going on the honeymoon.
Right.
So here it is. I have all these people. They trust me with their money, their life savings. And so I have Riley over here, who you haven't met, but you will.
Right.
He's the one that's putting together the investor package. Here's what's happening next. Thank you very much. Your money will be wired to you, to an ACH, whether it's to your self-directed IRA, you as a beneficiary, or to your taxable account, whatever it is. We have a lot of people who use trusts, which is fine.
Sure.
And then that's what happens. So you can expect this quarterly. Here's a calendar of when the payments are coming out. This is what's happening. Here's the amortization schedule of, 10 years of what it looks like. It's basically telling them what happens next. And that gives them the creature comfort of like, okay, this is great. There's a real operation here. It's not just some lawyer or something. It's like, okay, it's like I've given you my money. Now let's give them extra value so that when they pull the covers over their head at night, they know that they're getting paid on, May 20th.
Sure. And I will take that even further. I'll take that even further. Like
Sure.
Robert, my CFO, who's also a CPA, is my investor relations person and partner. And we send out a monthly newsletter to people, and we communicate with them regularly. If we're looking at a particular market, say we're going to go into Dallas or Atlanta, we're going to send our investors information on that market and kind of keep them warmed up. It's a warm and fuzzy. Hey, they're communicating with me. Most problems in just about any business come from a lack of communication.
Absolutely. I agree with you wholeheartedly.
Whoever you bring in, if it's you to start, if you're handling, you're going to wear multiple hats when you get started. You may wear the investor relations hat, and you may have to get started. Then you're going to be that person, and maybe you do a PowerPoint webinar thing online. It's so easy to do that now. You just talk about the deal. Maybe you talk about the specific property, and then you talk about what's going on in the area. And then these investors feel they get the warm and fuzzy. They can sleep at night, like you said, Sal, with their blanket pulled over their head. But that's another piece of this. So what's the next piece?
The next piece is to go out there and be the guy who's what we call aggregating all the capital. You're talking to the private investors. That is the biggest value or bang for the buck you can do no matter where you are. Because if you're raising money and you don't have the confidence or the experience, you can bet you can find someone who does, like Rod, that you can parlay those funds into, leverage his reputation, leverage his experience to do that until you get the confidence to do so. But if you're out there raising money and talking to private investors and that is the most important thing you can do. There's always going to be deals out there, but what you're doing is that you're building a reputation, or what I call a leverageable brand for yourself, by going out there and talking to private investors and networking amongst them. And then when the time comes, when Rod has something, you're there to do that.
Now, there are people that I know you train people in that, and I know there are people that do that for a living, and they basically bring the money to the deals, and you're exactly right. So I agree with you. Finding the money is probably one of the most important pieces, and if you're out there with your elevator pitch, developing relationships and sourcing money, and then you connect with an operator like myself, or there are lots of great operators out there. You connect with an operator. If you bring the money, you're going to get a piece of the deal, or you're going to get a hell of a paycheck. And
absolutely.
So that's a fantastic way, if you don't have the experience or the pedigree or the financial resources to take down a deal. Because, I'll be candid, if you're going to buy a 50 or 100 unit apartment complex, you're going to need some money to do the due diligence. You're going to have to buy the third party reports and all these things that are going to take a little bit of money. And if you don't have any money, go find the money. Go source money and do that as a business model on your first deal or two, and partner with an operator, right?
And that's how you add value. There's a whole industry around that. It's called real estate placement agents. And it's a prestigious inventory. All you do is go out to dinner and talk to rich people. That's about it.
Right.
And great.
Absolutely can make a fortune doing it. In fact, I interviewed a guy on the show that does that for a living, and he just connects with operators and brings the money. So he gets a big chunk, and
he doesn't worry about toilets or tenants. Or
he doesn't
like
do anything else except bring the money. So there's a definite benefit to having that as a business model. All right. So somebody's brand new, they're listening to the show, they listen to the podcast, maybe they've read my book on multifamily investing, so they've got some framework. What would you tell that person to get started, to actually take the plunge? What advice would you give them?
I would tell them right now, first of all, don't be scared of anything of talking to people. But what I would do is I would go out there. If this was me starting over again, I'd be talking to private lenders. I'd be talking to private investors saying, hey, rates aren't going. And I usually start off with something controversial because I'll tell them that I'm in real estate. They're like, really? Like, yeah. And I said, and I'll ask them a question. I'm like, the market's trading kind of high right now. What do you think? Well, I don't know where else to put it. That's interesting. And then I'll say something being, Salism, like, I don't think rates are ever going to increase, yields, rates. They're two different things, but you're not going to see like anything. Rates aren't going to increase ever again, I think, in our lifetime. What do you think about that? And then you just start off and you tee off with the conversation, then you go through with it, give them a copy of the pitch book with the deal. Here's some of the things we're looking at, and it could be one of your deals, whatever. But you got to start talking to people, and that's the most important part. And with LinkedIn today, it's free. It's never been easier to do this. When I worked on Wall Street, there wasn't a LinkedIn. It was very clubby, very private, and your business card would get passed around. Today, as long as you're wearing the right clothes to the party, you're going to be fine. And we've had people who have actually made a lot of money just by doing what you're talking about. You don't have to. I don't want people to worry about not having money, not having experience. Intellectual capital is 80% of the game, what you know and what you're saying. Everything else will just come to you as it comes together. However, there's plenty of guys like Rod out there, like you, who are going to be able to put the capital you raise securely as an experienced operator into these deals. And that's exactly what you want to be looking at. And you want to be focused on talking to people. Just get out there talking to people. Don't worry about analyzing deals. Let other people do that for you, but talk to people to raise money, because I will tell you, you'll get much further, much faster by doing it that way rather than trying to find the deal, then finding the investors, then managing it yourself. Just start off being the money guy, and then that'll give you the opportunity you need. And then pretty soon, after a while, you're collecting a lot of what we call these equity kickers in the industry, the sexy cocktail term, or hope certificates. And, then, there's no such thing as a bad day when you go through your filing cabinet and you see all the K1s of the deals you're in. I mean, I love that stuff.
Right. Right. No, and this is, I wanted to get Sal on the show because he brings that unique perspective of forget the deals, focus on the money. Exactly. And that's a very unique perspective. And I will add one thing to the intellectual capital comment you just made. Mm-hmm. And the other piece that anybody that's listening to my show knows I talk about regularly is the mindset. 80% of your success in anything is your psychology. Yes. Just act as if. That's one of my episodes. Just act as if and go out there and talk to people, and you'll find people willing to invest, and then you can match them up with an operator with a deal, and you either make a big paycheck or a piece of the deal, and it doesn't get much better than that.
Yeah, no, absolutely.
Well, Sal, listen, thanks for being on the show, buddy. I'm very grateful. And just so you guys don't forget, check the show notes. He's got offering a free done-for-you pitch book that I'm sure will add a ton of value because you guys need a pitch book, and you'll be able to get that. And Sal, I'll look forward to seeing you at the next mastermind, brother.
Thank you, Booby. I'll talk to you soon. Take care.
All right, see you.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please subscribe, and then take a moment to visit iTunes and leave a 5-star rating and review. For more resources to connect with us further, please visit our website at lifetimecashflowpodcast.com. Tune in next week for our next show.